So, Marty, when it comes to income tax planning aspects of estate planning, what's changed?
A few short years ago, when somebody came in to do an estate plan, planning was incredibly complicated. We had all the acronyms. We had GRATs and GRUTs and ILITs and IDIGITs and so on, and we still have all those. The focus of planning, the objective, however, was in many ways quite simple. If your client faced a 55 or 60% state and federal estate tax, you wanted to move anything possible out of the estate. Now, however, we have a 40% maximum estate tax bracket. For many clients, the ordinary income tax rate is really higher than the estate tax rate. For many clients that live in a high tax state, the capital gains rate can be higher than the estate tax rate or close enough to it. So for example, in New Jersey, you have a 30%, give or take, capital gains rate when you factor in the capital gains rate, the state tax rate, and the 3.8% net investment income tax. So you're facing close to a 30% tax on capital gains versus at most a 40% federal estate tax. So for all clients throughout the entire wealth spectrum, including the ultra-high net worth client, income tax plays a much more important role.
Okay, that makes sense. What else is driving the change to more emphasis on income tax planning?
The second aspect to this, which has really transformed the process, is that the federal estate tax exemption in 2015 is $5,430,000. In 2016, it's going to be $5,000,000. Got to think for a second, $450,000. So for a married couple, it's nearly $11 million before there's a penny of federal estate tax. So the reality is, it's only about 0.1 to 0.4% of decedents, maybe 4,000 people a year that die in the country, that will pay any federal estate tax. In practical terms, the vast majority of clients will never pay a federal estate tax. So now you're comparing either zero estate tax to a much higher income tax, or for a client that lives in a decoupled state, New York is recoupling, so soon by 2019 it'll have the same exemption as the federal. New Jersey is, I think, holds the record as the worst state in terms of the lowest exemption at $675. And I'm not sure which state, but there's one state that has the highest tax rate, which is 19%, but with that one exception, the highest state estate tax rate is only 16%. So look at what that's done to the planning dynamic. For the vast majority of clients, either estate tax is zero and capital gains is close to 25 to 30%, or if you're in a decoupled state, and I'm not saying you don't do tax planning for minimizing state estate tax, but if the maximum estate tax rate is 16% and a capital gain is 30%, the emphasis has to be on the income tax aspects of estate planning, not on the estate tax aspects.